Good afternoon and welcome to our discussion this afternoon on the role of private investors and markets in an equitable and innovative clean energy transition. My name is April Salas, Executive Director of the Revers Center for Energy at Dartmouth's Tuck School of Business. I'm joined by a very distinguished panel of experts from across the industry who are going to outline a range of topics for discussion this evening. We have Omar Blayton, CFO of Sunwealth, Scott Brown, CEO and Managing Partner of New Energy Capital, as well as Andrew Marino, Senior Managing Director and Head of Strategy at Generate Capital. So before we dive in, I'd also like to extend my thanks to the sponsors of today's event, Dartmouth's Irving Institute for Energy and Society, supported by the Revers Center for Energy. And a special thanks go to Jordan Sweat, Dartmouth class of 2019, who we had the distinct pleasure of working with during his time on campus. So thank you so much to Jordan. And equally, I would also like to thank Kate Salamito, Experiential Learning Coordinator at the Irving Institute, as well as our very own Madeline Bothy, Assistant Director at the Revers Center for Energy. So to orient you to this evening's event, we are scheduled for an hour and a half and have a great number of topics to make it through. Shortly, I will turn the mic over to each of our panelists to introduce themselves, their organizations, and to open with some framing remarks to kick us off. After that, I'll open the discussion portion of the evening, starting with some questions that we've prepared. And then while I do that, I invite each of you in attendance to start dropping your questions into the Q&A function that you'll see at your Zoom screen below. So as we start speaking, feel free to start peppering those questions. And Jordan has kindly volunteered to help me moderate those inbound questions that we'll attempt to get through this evening with all of our speakers. So let's dive in. Our framing for tonight's event include questions such as what role the private investors have and markets have played in spurring clean energy transition. How has that role changed in recent years? How will that role change in the future? How will the role that private investors and markets play in making the clean energy transition more equitable, particularly regarding inequality gaps, issues of racial, social, and environmental justice? And looking towards the Biden administration, what the impact private markets as well as investors' strategies to achieve renewable energy mandates while creating clean energy access for everyone. So working from this hypothesis that private equity and credit investors and markets play a crucial role in combating climate change and making the energy transition more equitable, I would love to turn it over to our first speaker for the evening, Omar, to introduce himself and offer his opening remarks. So Omar, over to you.
Thanks, April. As April said, my name is Omar Blayton. I'm the Chief Financial Officer at Sunwealth Power. Sunwealth Power is a asset owner and developer of a small scale commercial solar projects. So we're somewhat unique in that where most of the solar industry is either at the large end with utility scale projects in big fields, or on the small end with residential projects, or with large companies such as rooftops of big box retailers like Walmart or Target. We're really focusing on kind of the smaller businesses and localized businesses so that we have, in order to expand the impact that we could have through solar. And so the main reason we have this is in order to democratize the benefits of solar. Whereas solar has traditionally gone towards large businesses and high net worth individuals, we've really been focusing on trying to get more people, be more inclusive in the community that we reach through the projects that we do. So we focus on not-for-profits, low and moderate income homeowners, as well as small businesses, kind of your main street, urban environments, where we try to proliferate, as much as there are rooftops, we want to have solar panels on all of these roofs.
It's a really important mission. Thank you so much, Omar. I will turn it over to Scott Brown. Thank you.
Thanks, April. Let me say a couple of things about New Energy Capital, and then I'll say a couple of things just about my background. So forgive me for focusing on myself here, but since most of you are starting your careers in energy, I thought it might be instructive just to let you know that my career did not start in energy, didn't even come to energy until significantly later in life. And so don't be discouraged if you don't find the right seat the first time around. First, New Energy Capital is a small private equity firm. We were started in 2003. Actually started it with another Dartmouth classmate of mine, Dan Riker, who was Assistant Secretary for Renewables under the Clinton administration. And we formed it with the thought that there were proven technologies available in the market, primarily based in Europe or being deployed in Europe, that we could start deploying in the US. Essentially was almost virtually no solar industry in the US at that time, but there was an emerging wind industry and an emerging biofuels industry. So we raised our first small fund of about $60 million, and we invested in mostly biofuels at the beginning. We did some ethanol plants, some biodiesel. We did a little bit of biomass power, but we really focused that first fund on biofuels. Our second fund, which was raised in 2010, started shifting over to the power markets, but we were still early for solar in particular, although there was a fair amount of wind being developed at that time. Our focus at that time was on primarily landfill gas. So we did a number of landfill gas projects. We started shifting to solar in about 2012 and 13 as costs started coming down. And then our third, fourth, and fifth funds have been primarily focused on the solar markets, although we have done some water investing, some transmission assets, a little bit of a small portfolio of small hydros, and some energy storage as well. So we've spanned a number of technology sectors. Our view and philosophy is to stay a little bit ahead of the capital curve, and figure out where markets are going, and try to be a little bit more nimble with a smaller fund. So that's the background on New Energy Capital. We're based here in Hanover, New Hampshire. You can see my Dartmouth posters in the background, and a picture of Tuckerman's, which I have not skied, but all my children have. And we recruit mostly from Dartmouth folks, many of whom have gone off to do other things and then come back to Hanover. So we're fortunate to be here, and fortunate to have a fantastic team. So indulge me for a couple of minutes, though. I went to law school, came out of law school and went to a management consulting firm, Bain & Company. I spent a couple of years there, went back to law school and ran a program on international negotiation and arms control negotiations, which was a passion of mine at the time. Then I went to a startup company, which became First Solar, which is now the largest domestic solar manufacturing company, and ran their technology group for a while. And it's a strange coincidence because I didn't have a technology background, but I'll save that for another story. And ran that for 3 years. First Solar was based, it was then called Solar Cells Inc., was based in Toledo, Ohio, which is where I grew up. That was my connection there when it got started. But in the meantime, I'd gotten married. My wife didn't want to move back to Toledo, so the technology group was in Denver. So we moved, so I left the industry for a while. I went back to Harvard Law School and ran a program on negotiation there, and started a nonprofit focused on international conflict negotiation, and ran that for 4 years. And started having a family, was heavily into lots of international negotiations, primarily in South America and Africa, some in the Caucasus, in Eastern Europe. And then it became too much travel for a guy trying to raise a family. So I came up to Dartmouth to be the dean of the Tucker Foundation at Dartmouth, which then was a single foundation or unit, and ran the Tucker Foundation for 3 years, and fell back in love with Hanover again. We were raising our family at that point, and but I didn't particularly engage with academic administration. It was just, I was a little impatient for the pace, and so I left, not knowing what I was going to do. I wrote a book on negotiation, and then I started fooling around in energy again since I'd been on the board of the National Renewable Energy Lab for 8 years. So I started consulting with a couple of private equity firms, spent some time helping one of them develop a wind development company and a biofuels development company, and then started New Energy Capital in 2003. So I was well into my third career before I really sunk my teeth into the energy, and particularly into the project finance side of energy and finance side, which I had no experience in. So for those kind of launching a career, don't think it has to be linear. So I'll stop there.
That's fantastic advice, Scott. And I think every time I hear you speak, I learn something new about your background. So that's really impressive. One note too, it's kind of circular. I think Dan Riker was one of our first speakers when we were inaugurating the Irving Institute for Energy and Society. So it's interesting to see it all come full circle.
I still have a Dan Riker bedroom waiting for him when he comes into town. He usually stays with us.
always useful, but thank you. That's really good advice, and I appreciate you outlining your pathway into energy so that hopefully it inspires others as they're thinking about their winding, weaving, or straight and narrow path. Andrew, I'd love to turn it over to you.
Sure, thanks, April. And Scott, impressive. Omar, also, thank you for that. But, you know, Scott, I will say, my career has also been a winding path. I, however, have not been able to make it back to Hanover, though. So I'm super envious. So I'm Andrew Marino. I'm, as April said, Senior Managing Director at Generate Capital. Generate Capital is a little bit of a different beast from an investment fund. So we do take on institutional investor money, and our sole purpose is to build, own, operate, and manage sustainable infrastructure resources, mostly in energy. We hold all these on our balance sheet, though, so we don't really exit. And the way we operate is we build this infrastructure and we manage it all. We're about 100 people. About 25 of those people are investors. The rest are people in operations and management. We manage about 2,000 different generating units on our balance sheet, have about the same number of customers. Total asset value for us is about $1.5 billion, based in San Francisco, which is where I'm not based in San Francisco. I'm actually based in the Washington, D.C. area. But I came to Generate Capital about 11 months ago from a very different type of investor where I'd been for 16 years, which is the Carlyle Group. Big private equity, mostly U.S. buyout related firm in its origins, then expanded into a whole variety of different types of assets and strategies, buyout, technology, real assets, and energy. And I really came to understand and focus on the energy transition by doing a lot of work and a lot of investing in the industrial and energy sectors over time. In my last couple of years at Carlyle, I had started to really sort of, I guess, awaken to what was happening in climate. This is partially driven by the Obama administration, but also just the deep understanding of the way that not only dirtier energy, but industrial waste and industrial inputs are really starting to impact not only the cost of our industry, but also the cost on communities and environment. As a result of all of that, I was looking to invest in interesting places to drive sustainability. We did a couple of ventures in microgrids with partners like Schneider Electric. This year was labeled the most sustainable company in the world, interestingly. And then I came across this small company called Generate Capital, which at the time was about half the size that it was today. But they had a very interesting business model, which I think is critical for investing in this new wave of energy and infrastructure. And I'm sure my fellow panelists will agree. They were focused on a model which is building small scale distributed renewable infrastructure in communities and driving that sort of micro focus and deep hands-on focus to make energy, sustainable renewable energy, not only cost effective, but in a way that actually served customers in the way they needed to be served. So it had to be cost effective, it had to be flexible, and most importantly also, in the area of climate change, it needed to be resilient. So I know we'll probably talk about what happened in Texas later, but it had to stay with communities and continue to provide those services. I became convinced that as I was looking to make investments, that this type of business model was incredibly important and that larger investors were just going to take a very long time to get there. So I tried to buy Generate Capital with Carlyle. We didn't do that. The CEO invited me to come and help run the business, and that's what I did. And here I am.
That's fantastic. And it's really interesting too, to hear many of you really oriented towards your end customer. I mean, the communities are, Andrew, you're talking about resilience, and Omar as well, talking about the communities you serve. It's really important. And I heard that too in your background remarks as well, Scott. And so, just sort of pulling on that thread, now that you're in the sort of private investor seat, what role do you think that you have to play the markets more generally in spurring the clean energy transition? I'll start with Andrew, since you're still unmuted.
Sure. So I think that what each of us play, and I'd love to hear Omar and Scott's opinion on this, is as sort of risky capital that goes into new projects. What we do is we sort of shine the way for other capital markets, banks, et cetera, other investors that are maybe less interested, less willing to get their hands dirty, maybe a little bit more risk averse, but I don't think actually these assets are that risky. I think they just require work. But we show those through our investments, we show the rest of the capital markets that they can be not only sustainable from an energy standpoint and an environment standpoint, but also sustainable financially. And as we do that, of course, our cost of capital is a bit higher. We end up, we take a premium because of scarcity, maybe a little bit of risk, but over time, as we continue to spread those investments out, it opens the way for other investors to come in. And when that happens, the cost of capital lowers pretty dramatically, especially when you start to get commercial banks involved. And that allows a much greater proliferation of generating units and sustainable infrastructure, whether it's community solar, whether it's storage or micro hydro or other things, to proliferate in communities that need it.
Yeah, and as you sort of hit on that, and I do want to talk about Texas. I don't want to end tonight without talking about what happened in Texas and where we think there potential. Well, one, what happened, but two, where we think we go from here. As you talk about that, the risk premium, the cost of capital, has that changed over time or in recent years? Are you seeing, as you mentioned, there are different entrants in the capital markets now that you've sort of led the way? Has that changed in recent years for Generate or for your experience at Carlyle?
Well, I think yes and no. So where there are entry points, particularly in utility scale resources, where there even now pension funds are starting to invest directly, the cost of capital has dropped dramatically, and it's and that is really, the investment in those areas have really become a lot more mainstream. Where I think it's possible and it's interesting to continue to, and actually the most impactful from my perspective, to invest is infrastructure more on the edge, either newer but proven technologies or resources that have more of a community orientation, where maybe the contracting or commercialization is less less guaranteed. So, and this is actually where Generate has sort of built its home, if you will. We were one of the first people first organizations to commercialize hydrogen fuel cells for short haul transport, in this case in warehouse transport with Walmart and the U.S. Postal Service from Plug Power. That's an area, but also community solar is another risky area, not from a technology standpoint, but from a commercialization standpoint, where you can still get premium returns, but you have to understand the subscriber model and how to work with communities to make sure that your units and your investments are de-risked. So I think it's all of those, and I think that staying on that edge, at least for us, is really important because it continues with our central mission, which is to drive greater acceptance of distributed sustainable infrastructure through communities, so that other capital providers can bring money in and drive that proliferation.
That's great. Omar, how does that resonate with what you're doing at Sunwealth?
Yeah, it's extremely similar, where we're not necessarily focused on new technologies per se, but we're trying to open up a market of off-takers and a market of investors. And so it's the same logic though. You try to drive more institutional capital towards these areas by kind of proving them out and de-risking them in a way. And that's the way that you really kind of scale up the impact you can have. At the end of the day, if you can get people that aren't necessarily mission aligned and don't really care about what you're doing, but they know it makes them money, so they're going to put money into it, then you can have way more impact over time than you can by just trying to find kind of like-minded individuals to invest or to participate otherwise.
Yeah, that makes a lot of sense. Scott, any thoughts?
Well, let me just step back and put the context of private capital into the context of the broader market, April, since you asked kind of what is private capital and how do private investors play a role? And I think Andrew's description of where Generate plays resonates very much with where we have tried to play over the years as well, and taking that riskier, earlier, not necessarily earlier from a technology point of view, but perhaps from a capital formation point of view or a strategic type of investing point of view. But the capital markets do follow once you prove out the model, and that's the beauty of it. Once you prove that the risks are relatively low and that you prove that the technology works and that the cash flows are steady, tons of capital comes in. And so, just to put some context around that, the total invested capital worldwide in 2020 for renewables was about $280 billion. So that's about 20 times what it was 15 years ago. So the fact that capital has found its way into this market is really driving the industry. Private capital accounted for 85% of the total invested. Government and public finance organizations account for only 15%. So it really is private capital that's driving the industry and driving the transition from fossil fuels to renewables. Private equity firms, just so you're thinking on the equity side specifically, like KKR and Goldman, Blackstone, Apollo, NCAP, and Andrew's old firm Carlyle, have all raised funds in the sector just in the last 3 or 4 years. So that capital that's coming in has recognized this as a massive opportunity. In the U.S., it was about $55 billion invested last year. And that's a combination of debt equity and tax equity, which is then kind of reimbursed by the government through tax credits. So the market is massive. What it takes to unlock that market, that wave of private capital, is what Andrew was talking about, which is demonstrating that returns are stable, that returns can be predictable, and that returns can be higher than where investors can find yield in other places. And I think that's where we have tried to focus on those areas where we can demonstrate either by approaching relatively new technologies, new business models, or in some cases, and what we've been focusing on lately is where we think unlocking the most value in the market is, which is focusing on the early stage developers who are really the ones who go out and find and source the projects and put them in the right places. And so that's finding those kind of business models is what unlocks then the massive amounts of capital for the more stable parts of the market.
That's really good characterization. And Scott, do you think that, I know, and I'm often asked, what's the difference between the last administration, the incoming administration, how we think those priorities signal the market? Have you seen a material shift in your your sort of risk or project, identification, your portfolio overall? Has that shifted from this last administration to this administration? Do you see a lot of impact that maybe even government, signals play in the work that you're doing?
Well, the signaling is strong, but it's still just signaling at this point. So there haven't been any material policy changes that are affecting the market, but you're seeing a lot more confidence, I would say, in some parts of the capital structure. Tax equity, for example, is much more confident now. Partly that's just a result of coming out of the pandemic and having more assurance about future profits. There are some aspects of the market that I think people are very optimistic about from a policy point of view. The investment tax credit extension at the end of last year was a major boost to the industry. There's a lot of optimism about including storage, which is not currently offered an investment tax credit, but including standalone storage in the tax credit system. So a lot of optimism around infrastructure, around transmission and distribution, which is necessary, I think, to really build out the energy transition. And so that there's a lot of optimism about that infrastructure. And then there's some optimism, perhaps longer term, about broad-based incentives like carbon pricing, which would be wonderful from a point of view of really cleaning up the country and playing our role, our part in the energy transition and emission reduction. I don't know whether that's likely to happen. There's certainly a lot more positive talk and on a bipartisan basis about carbon taxes and cap and trade, but it's going to be a hurdle to get that through Congress.
Yeah, Andrew or Omar, any thoughts on that? Or generally, you know, any trends you've seen between last administration, this administration, and as Scott was alluding to, I think, you know, everything from infrastructure to ITC to carve outs for storage. Just thoughts on how that, you know, may be impacting your strategies.
Yeah, I mean, I think, you know, this administration, you know, one focus of theirs is going to be towards kind of disadvantaged communities, which kind of dovetails with our mission generally. So, you know, we look forward to seeing what comes forth in that. Also, you know, how we expect maybe not an ITC extension and maybe even a step up, which then allows, you know, the more economics in that project allow us to pay higher wages and do, you know, more impactful projects. And if anything ever got turned to a grant for some reason, then, you know, that changes a lot of the calculus as well. So, you know, we think that there are a lot of potential tailwinds in this administration, but, you know, until it actually comes out, we won't know it exactly. But I think the worst case is the status quo is fine. You know, we're still able to operate. It's not going to get harder for us to do what we need to do. So.
I think there are two big differences. One, Omar, as you rightly point out, is the idea of inclusive prosperity. That I'm just going to take that phrase from the current governor or the current mayor of DC, who taught me that when we were talking about how to work with the new DC Green Bank. But inclusive prosperity is something that is absolutely on the mind of the current administration. I think that's fantastic. The other thing that I think is interesting is not only you know, is there going to be a recognition and leaning into investment tax credits, but also I think a broadening of the ability to use investment tax credits and other credits like LCFS credits for low carbon fuel to promote electric vehicles and other things to broaden out the use of technology and the ability to moderate or to diversify the types of sustainable resources that go into the energy mix.
That's a great point. I know we talked about smart infrastructure and potentially the opportunity it might play. I think one question that's come in through the chat is, you know, is there a way to bring in lower investment minimums to recruit a larger potential investment group, perhaps using the newly permitted investment crowdfunding? Any thoughts on that?
I mean, we've looked at it every now and then. You know, the limits on the crowdfunding without, you know, at some point you have to register. You know, obviously, like, a lot of these funds are going to be towards accredited investors to get around registration requirements. Crowdfunding was supposed to be an opportunity to kind of circumvent that, but that's only up to a maximum size, and you know, it's too small for us. So I know it's too small for Scott and Andrew, but you know, that is something that, you know, not necessarily the crowdfunding angle, but trying to open up the investment possibilities to non-accredited investors is something that, you know, we explore every now and then, and we'd like to find a solution for. So it's just a matter of how we can go about doing that. But yeah, it's not easy. A lot of investment structures are set up for, and the underlying assumption is that if you're rich, that you're sophisticated or smart, which isn't necessarily the case, but that's kind of the proxy. And it's hard to figure out other ways to allow other people into that pool.
Well, there's some great questions coming in here, and I'll just read, the shorthand of this one, and it's, can we create something so regular people, college students, can join these investments? I think that's an interesting question, sort of piggybacking on the last one about maybe even democratizing access to the investor side. Sorry, go ahead.
Well, one thing that's been floated a number of times, but it hasn't yet gotten any traction, is to open up the REIT and MLP structures to renewable assets. When MLPs were authorized for energy assets decades ago, for some reason, renewable based energy assets were excluded from MLP authorization. So that would allow publicly listed partnerships or publicly listed REIT structures to open up for investors of any size. And that would democratize it substantially. And I know that's being floated again in the current administration.
I'm on mute. Another question that's come in through the chat, I think it's one of our tech students, Nate Smith, asks, how would a tech neutral tax credit impact the way your companies view investing in new innovative technologies? Would the tax credit alone decrease the risk enough to push unproven technologies? Who wants to take that?
Well, I'll take a shot at it. Of course, the answer for that is it depends on whether the where the technology is in general for a tax credit of that type. You have to think about whether it is you get the tax credit for just availability of having the resource. For example, like hydrogen fuel stations in the state of California. The LCFS credit regime allows actually an incentive to have hydrogen fuel stations just available, with the hope that it will spur demand. So in that case, maybe it would help a newer technology where the market demand, particularly for transportation of hydrogen, using hydrogen refueling station, really isn't there to provide commercial returns. In other cases, it depends on magnitude and scope, and also the overall the risk of the market that you're involved in. I think in general, if the technology doesn't work, it doesn't work, and so that's a very different style of investing, or a very different bet that one has to take versus whether a technology that works has market acceptability. So I would say, in summary, to kind of try to get to the point, that the type of tax credit, if it were to exist, would be more applicable to the latter. New types of infrastructure that did work, but the question was really, how does the marketability work, and can you reach the level of market acceptance with your investment? It helps minimize that risk.
Yeah, I would reiterate exactly that point with just a couple of examples, April. One is the cellulosic ethanol. So there has been an incentive, not a tax credit, but a different incentive for cellulosic ethanol for the last 15 years. And the technology has never been scalable in a way that makes it profitable, even with significant incentives from the federal government. And so you have to have a technology that's going to fundamentally work, not only work, but scale. And I think that's the key. So tax credits are extremely effective, as they have been with wind and solar, because it enabled those technologies to scale up. And I think storage will be exactly the same. And there are a number of others that will play in that role as well. Another that has not worked, I worked for my congressman for a while back when I was at Dartmouth, 1976. In the wake of the first oil crisis, I was working, doing a briefing paper for him on fusion technology using tokamak reactors. So that was almost 40 years ago. And now tokamak reactors are still being subsidized by the government to see if we can create sustainable fusion reactions. And if the technology is that difficult to scale, tax credits for private investors are simply not going to have any impact. So it's got to be funded by the government or not at all.
Yeah, and that seems like a really, a sort of well-placed type of project for something like an ARPA-E, right? Who wants to maybe take on that risk, advance the TRL, the technology readiness to commercialization, and using sort of a unique way to complement than where the private market might pick up after it's taken on that risk, would you say? And on that note, we had a question about a really interesting technology. I think it just went away. It was to do with, here we go, cement blocks for storing solar energy. Sounds like from Bill Gross's Ventures. This is coming in from the chat from an anonymous attendee. Any thoughts on that? Any familiarity with technologies like cement blocks for solar energy storage?
Well, I have some familiarity with this actual technology, maybe a little bit more familiarity with cement for carbon sequestration, which is where you think more about building materials. I don't know if there's been, it'd be great if you could create cement blocks to actually store energy like a battery. It'd be great if it works. You could build it in houses and it all depends on the output, but I don't think there's been any real commercial efficacy that's been proven other than the chemistry.
Do you have another question that came up was around next gen nuclear thorium reactors, hydrogen fuel cells? Any reactions to those technologies?
I reaction to hydrogen fuel cells. The other technology I'm not that familiar with. So hydrogen fuel cells, are in the market today for different applications. Of course, there are different types of hydrogen in the market. There's hydrogen that gets created. Hydrogen can be pulled out of the atmosphere and packaged by applying a huge amount of energy and some technology to it. The creation of that energy, depending on how it's generated from fossil fuel sources or carbon sources or non-carbon sources, determines the amount of environmental stars it gets. The highest being green hydrogen, which is created from renewable sources. That hydrogen, the green hydrogen, is still very expensive relative to, what I would say its regular weight competitor, which is, a big part of the grid, say in ISO New England, natural gas, which is still reasonably low carbon. And I think that it's, green hydrogen and fuel cells has its applicability for very specific applications where you have, let's say, specific providers who have a real desire for 100% green energy that's also totally resilient, like say Microsoft's data centers. They have a very strict guideline for zero carbon, and they're building out microgrids and resilient energy sources for data centers that need to have 5 nines of reliability. A great thing for that are fuel cells. The only type of fuel that works in a fuel cell that really can sustain that level of low carbon load is green hydrogen. Very expensive, and it's not around. The application is not used that much, but that's one area where it's finding itself some commercial use. But the technology is rapidly advancing. 2 years ago, nobody thought hydrogen was going to work at all. And now it's starting to make its way in a lot of mainstream areas, particularly the non-green kind.
Absolutely. And I know we've been talking a lot about innovation, so I'd love to sort of transition that to how it applies to, sort of the end user. As we look at, one question here is on pushback, right? And smaller community solar in this example, in some states, where utilities are claiming a risk of increased rates for people unable to purchase solar. And so when I think sometimes about leading edge technologies or innovation in clean energy, we think about sort of who bears the brunt of the technology risk and also maybe the cost to implement. And, is it a sustaining model? Does it have the resilience built in? And as always, are we thinking about generalized social equity, as this clean energy economy grows? So I'd love to transition more to how your investment thesis, really takes this into consideration.
I can address community solar initially and then turn it over to Omar because more directly responsible for focusing on this market. But when I think we were the first investors in a community solar platform, there was a little small company out in Colorado called Clean Energy Collective that started the community solar model back in 2011, 2012. And it was interesting for a number of different reasons. They were starting it there because they had a number of rural residential areas that were had tree shading, and so solar doesn't work very well if you got shade on the roof of your house. So they were focused on that market. But what immediately struck me was the fact that for most low-income individuals in the U.S. don't own their own homes, and and therefore can't put solar or don't have control over their rooftops to place solar. And even if they live in a single family residence. So community solar is sort of like liken it to a condominium model where you can put a relatively large scale solar array on a flat piece of land within the service territory of a utility. And that energy can then be delivered to subscribers who sign up for a portion of the output from that solar array. And so it opens up a big part of the market. It opens up the market for those homeowners who either have north-facing roofs or have trees around their house. It opens up the market for small commercial enterprises who don't own their buildings and lease them from commercial landlords. And most significantly, from my point of view, it opens up the market to low-income residences who rent their homes rather than own them. So it is a significant opener to the market, and I think that's one of the things that attracted us to that business model as a structure. Now, ironically, Clean Energy Collective ended up going bankrupt. So even though the company has a great idea, doesn't mean they can always execute on it. Still have to have a good team. But community solar as a concept now is widely distributed around the country. Most states have to have authorizing legislation in order to enable it. But a majority of the states in the country now do authorize community solar, and it continues to grow rapidly throughout the country. And I know Omar's company is focused on that market in particular. So.
That's right. I mean, I think community solar basically takes advantage of the concept of net metering, where where the solar is produced isn't necessarily a virtual net meter, isn't necessarily where the benefits have to lie. And when you have jurisdictions like that in states that allow for that, you can do a lot of creative things structurally to really get the benefits out there. We do a lot of low and moderate income community solar in Massachusetts and New York. One of the projects we're doing in New York now is on a housing development, housing project. So we put it on the housing authority's roof, and then we sell it to low and moderate income customers inside, not necessarily in the complex itself, because I don't think they have individual bills, but within the network, the NYCHA, the Housing Authority network within New York City. And so we're doing a few projects like that. We have concepts in Massachusetts where we can provide lease payments to some low and moderate income homeowners, and also sell power other ways to low and non-low income off-takers. And so those are different ways that we're able to kind of really spread those benefits across. But primarily what we do is really just kind of fundamental underwriting of the off-taker. I mean, so like we always say, like non-credit rated doesn't necessarily mean not credit worthy. And just because you may be a low and moderate income homeowner or customer doesn't mean that you can't pay your electric bill. You probably can. You probably will. But it's hard. It's hard to underwrite these small cases when you don't have a proxy like an S&P score or something like that. So what we're really trying to work on is ways to kind of scale up the underwriting kind of at the local, the fundamental like local level, in order to kind of proliferate this beyond our footprint so far.
Are you seeing more innovation? I'm glad you brought that up, because I think I've heard a lot more innovation happening in the space of how to assess sort of credit worthiness or credit risk in the access to clean energy technologies that ultimately are lowering costs, theoretically, right?
Yeah.
But if you're talking about having to own the structure or have a tax base through which to have, the ability to write it off and see value, or the concept of having to pay up front for all of that offtake, over the next, whatever that investment horizon is. Are you seeing innovations, on sort of, at the point of implementation around that credit scoring, and then also on the financing model or the access model, offtake model for individual, I don't even want to say homeowners, but individual residents or community members?
Yes, I mean, different people are trying different things, but to be honest, like the best innovation for us probably come internally, just because we have about 400 projects now, and so those are 400 data points we can use and test out. We don't have any defaults so far, and so but to the extent we do get a default, we can analyze it, look at it relative to the rest of the data set, and try to tease out some theories and some policies on a go-forward basis in order to scale this up. So I mean, as we're getting more projects, we can get more information and we can kind of underwrite better for future projects. And so I think we're at a point now where we're able to do that, and that's what we're actively doing. So we're not necessarily looking for third-party solutions, even though we kind of read up and learn and talk to people all the time. The lived experience is probably going to be the best source of information for this.
Yeah, Andrew or Scott, any additional thoughts there?
The only thing I would say is, Omar, you touch on a great point, which is something that you have to live with when you're in this market, which is the ability to underwrite credits that don't have any sort of standard out there or I guess benchmark to look at. So there's and this is in community solar. It's also in C&I solar. A lot of small companies or that want to use solar or some sort of energy associated with it. Especially if you're providing the energy as a service, you have to do your own work to try to figure out the reliability and the credit quality of your offtake. This also impacts other markets like electric vehicles. One of the reasons why electric vehicle financing or used electric vehicles aren't as prolific in the market is that the financing markets aren't there. And the reason why the financing markets aren't there is we just don't have the data on reliability of electric vehicles like you do with internal combustion engine vehicles. But these markets will mature. And it's kind of the fun part. One of the fun parts about being in this industry is you're able to, as you drive these new solutions, particularly for communities and particularly for, frankly, low and moderate income communities. I imagine that's also just Omar, I imagine you just get a tremendous amount of gratification from being able to underwrite communities and supply energy to them in a way that nobody has really done the work to do before. Get back to my point. These models are very labor intensive, and you have to be willing to dig in and get your hands dirty and think hard and do the math, take bets yourself. Can't rely on other people or banks or anything like that in most cases.
Yeah, and there's a question in the chat I think it's interesting. Do we think there will be a new standardized energy credit system in the near term? I mean, that might be an interesting question, thinking about maybe the role that government can play, or is that the capital markets, the private markets that might drive something like that, or at least create the momentum?
The one area where I've I think there's active discussion is in a carbon tax and rebate program. So where, you know, there is basically a desire to make it revenue neutral. There's quite a concern that carbon tax will have a negative impact, a regressive impact, and a negative impact on low-income communities because they spend a greater share of their income on energy. So the question is, how do you remedy that? And the answer, of course, is you tax, but then you rebate back to low-income communities some of those funds. And I think that's where I've seen most active discussion around a credit system that would support, in particular, low-income communities.
Mm-hmm. That's great, and I want to reserve time to also talk about Texas. There's a question in the chat that kind of maybe tees it up for us a little bit, but it's talking about utility scale projects. In this case, they're saying, you know, due to less available sites. So, you know, are utility scale projects becoming more scarce? Is there potential to create a capitalization platform, equity, tax equity, debt for small to mid-sized solar projects, 500 kilowatts to 3 megawatts? And I'm going to use this to transition us into the conversation about Texas. Anyone want to take that first question about capitalization platforms for smaller projects?
I mean, yeah, that's, I think, what we all do. So, you know, whether we invest in those platforms from an equity perspective, or we are those platforms, or we provide the financing for those platforms. That's what distributed generation is. It is it's building out resources with common financing and underwriting them in a way that is low cost, maybe more resilient than the utilities.
Yep, we're doing it.
I was going to take that on.
Right. Here you go. Right. So you want to talk about Texas?
I want to talk about Texas. There are some questions about net metering, but I'll come back to that one. Let's talk utility scale, distributed. I think, Andrew, you're hinting at it. Who wants to frame what happened in Texas? And then we'll talk about where we go from here. Andrew, Scott, Omar?
I can frame a little bit what happened. I don't know exactly where we go from here, but I'll just frame it up, and then Andrew and Omar can jump in. But so a few things happened in Texas. It got really cold, so demand went up because most of heating in Texas is electric. So as soon as it got cold, the demand for electricity went up above where their forecasts were. So that was one factor. Second thing that it was a coincident event was that there was a lot of capacity that was offline. Generally, demand is low in the spring and the fall and peaks in the winter and the summer. And so generators often take their systems offline in the spring and the fall to do standard annual maintenance. So there were some generators that were just offline. So demand was higher, capacity was lower than anybody forecast. And then because of the nature of the weather events, there were particular generators that went offline that otherwise would have been offline. There was some initial conservative focus on wind turbines as a culprit, but only, I think it was something like 13-14% of the undercapacity was attributed to wind turbines. They were 13% below their forecast capacity. 80% of the shortfall was caused by fossil generation being below their capacity, and that was from two reasons. One, coal, although the coal folks like to say that coal is very resilient, only if you plan for weather events like this. And in many cases, the coal piles froze and they couldn't actually get the coal into the generators in some of the locations. So that was part of the issue. And then on the gas side, a number of the wellheads had challenges because of the cold weather. And so the gas supply was also lower. And so fossil generation was down substantially below where the forecast, even in an extreme weather event, predicted. Solar was not below its forecast at all because it wasn't forecast to provide any energy during weather events. And so solar was not a culprit. Wind was below where it was expected to be, but not by nearly as much as fossil. So, wind, by the way, can be extremely reliable in cold weather. It's just that nobody had installed the cold weather apparatus to keep the gearboxes warm that they apply when they build a wind turbine in Minnesota. Well, it works just fine, but they say they were trying to save money and didn't put the weatherization packages into those turbines in Texas. So I'll just stop there.
I think that's the primary question I see coming into the chat. I mean, and this is, again, we'll call it Chatham House rules, but as freely as you can speak. But was the energy crisis a result of poor planning or a result of an unregulated, deregulated market? That's the way this question is phrased.
Well, I think it's important to think about the structure of the ERCOT market. And there are two. I mean, the structure of ERCOT was set up with two really interesting characteristics. First of all, it's its own standalone market. It doesn't really interconnect with other markets, which means that when it runs out of power, it can't do anything. So that kind of stinks, and we saw what happened. The second thing about the ERCOT market is it's unique in that it has no capacity market. So it's very deregulated, which means, and it basically says it's got, I think you said, you framed it right. Nobody thought that the capacity was going to be that low. Nobody thought that the weather was going to be that bad. Okay, well, humans, here, newsflash, humans are fallible. And we need sometimes the certain regulatory frameworks or market frameworks that can help us, in this case, this is what a capacity market does, bid our spare capacity and get paid for it so it's reliable and online. It's when it needs to get used. In this case, it can get used. That was the second thing. ERCOT doesn't have that. And so you had sort of the triple whammy of weather hit, all these different generation types went down. Two, there's no capacity available. Nobody bid into it, so nobody had really prepped for it, and nobody thought about the investments or thought the investments were worthwhile to make sure that they had capacity up there. Why? Because they weren't going to get paid to do it, or they would make that bet. And third, they couldn't rely on their neighbors to really draw power. And so the real question is kind of, I guess, what happens now? And I'll just throw this as a little bit of a leading question. Texas experiences really dramatic, catastrophic weather. In fact, it's happened almost every year for the past decade. Not quite true, that's an exaggeration. I would posit that's because of climate change. And it'd be interesting for somebody to do an analysis of the cost of rebuilding those communities versus adding a little bit of resilience into the grid or extra or building in a capacity market or interconnects with other markets. Very interesting. I think one of the reason why people don't is they just don't assume they'll say, oh, every weather catastrophe is just a one-off, but of course it's not. And that's the reason. That's a big reason why I'm in this business, because if we don't do something, things are just going to get worse and worse and worse.
Yeah, absolutely. And I, Omar, I'd love to turn it over to you as we think about the opportunity that a more distributed grid might play, for consumer protection and really looking at the end consumer and potentially mitigating some of the negative impacts. I'd love to hear your thoughts on this.
I mean, I think the big point that's already been said is resilience. You're trying to create more resilient communities. And so resilience is, power resilience. It's also, health benefits, cleaner energy and sited in communities otherwise suffer from pollution, that helps to mitigate some of that. Not just, the solar panels on the roof, but, internally as well. So there are a lot of things. A distributed model is, somewhat necessary. I think the old way is a little bit, antiquated and based. It made sense, at the time, electricity first started, but it's vulnerable for all kinds of reasons, not just weather related, but then you talk about, from a geopolitical standpoint, there's always, this risk that keeps rising up. So I think that, there's a whole lot of virtue to distributed energy system.
Yeah, and do either, I mean, does anyone want to speak to, where maybe this is potentially where technology can also play a role, or market mechanisms like demand response or energy efficiency types of programs that might, mitigate some of the impacts, or at least the duration of outages as it results to a lot of the changing factors that, consumers are dealing with related to extreme weather. What do you guys think about the role that some of these potential technologies can play in alleviating this?
Well, the most obvious one is storage, both distributed storage and more centralized storage, to be able to make the grid itself more resilient and be able to sustain outages and recharge the grid with storage assets. And so that is something that is the mechanisms to do that have not yet been well defined in any market, not just ERCOT. So that's evolving. It is evolving in tandem with the technology advancement. And so the cost of storage has to come down substantially and is dropping very rapidly. So that will happen. But at the same time, the regulatory framework also has to change to help utilities integrate those storage assets into the grid to make it more resilient.
I agree with that, Scott. And I think it's an area that I'm particularly excited about in terms of the ability to use storage to augment as a revenue source and a source of resilience to in communities. If I took a step that, and I think that's a sort of nearish term, really present potential in our communities. I think longer term, my own view is that we're not going to be able to solve the climate crisis without a much broader distributed grid with smarter grid systems that help manage flexible resources like storage, but also are able to spin up connected generation types as they're needed. That's going to require something that also the Biden administration is very focused on, which is ubiquitous broadband to communities, bridging the digital divide and giving the ability for communities to use data to spin up and spin down their resource generation, and also through sensor technology and other things, manage their resource needs in a more efficient way. And where I think we ultimately need to go, we're all doing what we can, but until we start to have a much broader based ability for municipalities to manage their resources in a faster, more intelligent way than frankly we can, based on what's going on in the grid, it's going to be hard for us to reach the level of carbon reduction and efficiency that we're going to need to reduce the rate of climate change.
Yeah, absolutely. Those are all great points. And there's some really great questions coming in from the chat. So I'm trying to keep up with them all. So keep them coming. One in particular is looking at the role, or potentially the shifting role that government might play in RTOs to gain more control over regulations, as it's put here. Do you think that this is going to highlight a greater role for the sort of, I'm assuming federal government when they say government, to play in some of these regional transmission markets?
I think they'll have to, frankly. I think that's the only way you can have this level of complex regulation. And what I think will, I think state and federal governments will have to play a role. The issue is that these, I think the way these markets are regulated and open will have to evolve because the science is evolving, and we don't really have a grasp in a detailed way about how connected but distributed grids behave when they're all working together in a flexible capacity or flexible frequency markets. And so it'll be really interesting to see, and we'll make some mistakes, and the regulations will be imperfect. But ultimately, it's a very, very exciting area to think about.
Yeah, and I think, April, to your point about the federal regulation of the markets, there's still this tension between state control and federal control of the energy markets. Most rates and tariffs are set at the state level, but the federal government has responsibility for and jurisdiction over cross-state transmission. So these regional transmission organizations you mentioned are regulated by FERC, and they have certain reliability requirements imposed by FERC. And there are also certain competitive dynamics that are managed by FERC. But there are not all of the country is subject to a regional transmission organization, or what we call an organized market. So I love the term organized market because it implies that the other markets are the disorganized markets, which is quite true. I mean, big swaths of the Southeast and parts of the West are not subject to any regional transmission organizations that can coordinate reliability among the different states. And that really does need to happen. And you're seeing, I mean, as Andrew pointed out, one of the problems with Texas is they did not want to be subject to FERC jurisdiction. And so they kept themselves isolated from a transmission point of view to avoid federal jurisdiction. But the result is that they don't have any access to surplus power from neighboring states when they have a shortfall like they did in the past crisis. So I think we are seeing increasing benefits from organizing on a larger scale that will allow transmission of surplus energy from one region to another, and then integrate that into a distribution system that is fairly allocated.
Well, I wasn't expecting to take this global, but there's a couple of questions coming in around the elements of national security and, the benefits of decentralized energy grids, as that a reason in and of itself for government investment? And there's a follow-up question around, countries and governance models being successful in solving climate change soonest. So, for example, China and its top-down decision-making, are they able to pivot more quickly? Or in this case, they say less developed countries potentially are also less entrenched with old infrastructure and corporations to replace. Any thoughts on elements of national security in terms of investments by the government, or even just, are there other models that we've seen around the world that we think we could apply here as we look at clean energy transition and broad scale investments? And maybe I'll start. Yeah, Andrew, go ahead. I know you've done a lot of work globally as well.
I mean, the biggest thing that I think it comes to me to cybersecurity. In the end, our grids are going to get more distributed. They're going to be more data driven. They're going to be distributed but connected, not in the way utility is connected. So there won't be a sort of a central point for a kind of a disaster or a cyber attack. But the issue will be is that information systems will manage them all. NOCs are going to become increasingly sophisticated. So I think one of the best things that the government can do from a security standpoint is really cybersecurity, and making sure that that's nailed down. In terms of China, I think China is a really interesting model because China is trying to corner the market in a couple of technologies, notably battery storage. Becoming one of the largest manufacturers in battery storage globally. I think something like 2/3 of the capacity of battery production is in China right now. I think a couple of things will be interesting about that. One, it will drive battery costs down in ways that I think few other countries can do. The other thing that's going to be interesting about China and the proliferation of green technologies from Chinese manufacturing base is also how other end markets interact with China as a source. So for example, German car manufacturers, German car manufacturers have been very proprietary about their components. and very particular about their components, up and down the value chain. Are they going to accept Chinese-made batteries with everything that comes along with it, including, maybe thinking about what's going on in Hong Kong or other things? Or are they going to need to have their own battery production or do it from some other place? So I think those global supply chains and where they and think about China in particular, very interesting, sort of multifaceted topics. And as you know, April, I spent, I was an Asian studies major at Dartmouth, and I spent my first several years out of Dartmouth in China, right when it was sort of moving into the market economy. So China is a very interesting area for me to think about.
And Omar, one question came in specific to blockchain. It was talking about RTOs, but I actually want to ask it in a bit of a different framing, which is the opportunity to engage more communities in transactive energy. And do you see that as a future for Sunwealth or for the market that you are operating in?
So I guess maybe, I don't know how yet, right? So, I mean, when I look at blockchain, what I think about more than anything is transparency, and being able to kind of, maybe provide, records of ownership and things like that. There's something to be said for that in any kind of transaction. Does it, are you just trying to have a blockchain hammer and everything's a nail? I mean, I think there are other parts to this that are, to solving this issue that won't require blockchain. It might require more, rudimentary technology, but, start with that and build up. And, we get to a point where there needs to be kind of this distributed, ledger of transparency. Then, we can always layer that on. But I don't think, I mean, I've heard of different, clean tech startups, using blockchain kind of in communities. And, I feel like they threw blockchain on there just to get VC money. It was a buzzword, because I don't know if they're even around anymore. But yeah, so it's cool. I like the technology, but yeah, I don't know how we use it.
Great. Scott, any last thoughts on that before I transition us to wrapping up?
Not on blockchain. No, I was watching a couple of startups, and like Omar, I think they were failed models. I do have one comment on national security. It's actually not national security as much as it is just kind of geopolitical dynamics in general. One of the I think real benefits of clean renewable energy is the reduction in dominance of the oil petrostates, including Russia, but also a lot of our defense dollars and a lot of our national security attention is on the Middle East and on shipping lanes. And I think that will drop dramatically, or should drop dramatically, with the distributed energy and renewable sources. But if you think, just putting the United States aside, when you have petrostates, mineral dominant states, or any monopolies controlled by the government, you have the opportunity for the government to extract rents from its people and for a lot of corruption. And most electric utilities worldwide are controlled by the governments, and they're often controlled by corrupt sources, and you have a lot of corruption in nationalized electric utilities. And I think one of the real benefits worldwide for distribution of renewables on a small scale is the ability to break that monopoly power and allow villages and distributed electricity to get to communities without the control features that come with nationalized electric utilities. And I'm really looking forward to seeing whether that affects geopolitical situation worldwide. I think it'll be interesting.
That's a great framing, and it really dovetails nicely into my last question. But we have a number of students who are dialed in today, and I think we started with the optimism for not having to take a very straight and narrow path to get into this industry. As we've talked for the last hour plus, it's really incredible to see the amount of innovation, the pace of change, the different roles in different parts of the industry, and even just hearing about your respective backgrounds. I'd love to just hear from each of you in, a minute or two or less. What are you most excited about from your role in as a private market player in equitable and innovative clean energy transition? And what advice would you have for young people looking to get into a career in any aspect of the topics that we discussed today. I'm happy to cold call, putting on my tuck hat. So I don't know, Scott, do you want to lead us off on that? That big meta question. I think you you had the best advice coming out the gate to help frame this question. So let's turn it over to you.
Well, what am I most looking forward to in this? I love the new technology. I love new technologies. I love just seeing what's out there. I don't often invest in them, but I love watching them and seeing and theorizing about what's going to develop. You know, when we were starting for solar back in the late 80s, we thought at that time that a 10 megawatt production facility would be world dominant. And now a 10 megawatt single facility is tiny. So the pace of change in the market and seeing how technologies have evolved so quickly, to me, is just incredibly interesting and fun to watch. So that's one aspect of it. I really next phase of my career, I really would like to see, putting aside what I'm currently doing, really would like to see how this technology can influence international development. And so I think that, to me, is an exciting untapped potential of this technology, and so that's what I'm excited about over the course of the next 20 years.
That's great. Andrew.
So I'd say what gets me up every morning, and what I really enjoy about this industry, is the fact that there really is a community. And so, yeah, everybody in this industry has a similar mission, and that creates a level of camaraderie among industry participants that's just, it's great to be a part of. Frankly, it's not like any other industry I've been in. So that's number one. And I think everybody in this industry is trying to actually do good. That's a big differentiator from a lot of other potential careers that one could have. In terms of getting into it, there are a lot of avenues to get involved in the industry and actually have a very good career. There are tons of small companies that frankly need help. I mean, tons. There's also a lot of other areas that are government sponsored but private market facing areas, that, like the New York Green Bank or the DC Green Bank or offshoots like that are great places for people to go and work and learn about how to finance finance solar or new technology, depending on what these different states do, and to start to get their feet wet and gain some skills and either stay there or move to other players, either manufacturers or sponsors or government regulators.
That's fantastic. Well, and I think too, the recent announcement of Jigar Shah, your colleague, heading into DOE and the federal government, and Dan Reicher starting a portion of his career there, as Scott, alluded to it. Hopefully that feels inspiring as well, and expands the scope of potential roles. Omar, I'd love to turn it over to you for final thoughts.
So I guess the part that gets me most excited is, the opportunity to kind of advance not just like climate mitigation, but the economic justice aspect of it. I mean, I think that you're dealing with an industry that's heavily government backed, and when you kind of get those incentives from the government, and that money can kind of be distributed in all kinds of creative ways. You're not really looking for an individual that has a whole bunch. I mean, you are looking for that as well. Individual, a whole bunch of money, they just kind of like distribute it some kind of way. I mean, what slice of that is able to kind of be moved around depending on if you have the will to do so, and you don't let any particular party be overly extractive in the transaction. So, and I think that for the U.S., but also that kind of can go internationally as well. You have kind of NGOs and things that'll back these technologies for the climate change aspect, but you can take that and kind of multiply the mission, I guess, for that. So that's think that's really cool about this industry. As far as getting in, I would kind of echo what Andrew said, but I would say there are places that are hard to get into as a junior person, but there are companies that look for junior people, like people right out of college. I mean, Sunwealth is one of them from time to time. We're not huge. We don't have 100 people, but we just put job postings out a couple months ago, and probably do it in another few months. And getting your foot in the door and getting that experience, I think is huge, is invaluable. You can try to go higher level and go like this big company and kind of get lost in the shuffle. Maybe you'll get experience, maybe you won't. But the going to like a smaller place or some place where you're going to get hands-on experience, and where you're only kind of limited by your own ability and kind of desire to grow. Because you're at a small place. I mean, they need all the help we need all the help we can get. We need people to kind of maximize their potential. So that is something that's to be said for working for a place like that. And doing that, build your resume. And so if for some reason after 2, hopefully at least 5 years, you want to do something else, you have like this long deal sheet that you can kind of point to, and go into other areas. So I would encourage that. Speaking as someone who did not take that path, I didn't talk about so I was a lawyer before, and then I went into investment banking and leverage finance. And one thing I kind of learned there is the people that came straight out of college and the analysts knew way more than me, coming in as an associate, but not having kind of that experience. And so if you know what you want to do and you kind of get in there and get that leg up, it really it's like any other trajectory. You start off, and the further it seems like it doesn't diverge at the very beginning, but the further you go out, you see how big a difference certain moves or certain angles you make. So
well, those are great lasting words to leave us on. And I think my biggest takeaway was your comment about our opportunity to multiply the mission. I think that's certainly a really good and inspiring takeaway for us all. I really thank all of you for such an incredible discussion today. I know it was a little bit winding, but we got to a lot of the questions coming in through the chat, and thanks for being open and for your candor and answering and fielding these questions live. So I just wanted to say thank you, and I'm going to turn it over to Jordan to close us out.
Thanks, April. I can speak for the audience when I say that we're incredibly grateful to hear everyone's expert opinions on how the industry can tackle issues of climate change and social inequality, and many of the other topics that we got to tonight. These will only become higher priorities in the national and international spotlight as time goes on. So I want to give a huge thanks to Omar, Scott, Andrew, and April for taking the time to share your views. Your insights are truly invaluable, especially to a young professional like myself, and a lot of students as well. I also want to thank both the Revers Center and the Irving Institute for sponsoring this discussion. And again, as a former student, I can't stress how fortunate the Dartmouth community is to have both of these centers and their staff as resources. So thanks everyone for joining us, and have a great night.
Thank you.
Thanks all.
Thanks.
Thanks for organizing, April.